Okay, let's look at gross debt service ratio and total debt service ratio mortgage edition. So how the gross debt service ratio and total debt service ratio may affect how if you in fact do qualify for a mortgage or not. So let's take a look. So the gross debt service ratio compares a borrower's housing related expenses to their gross income. A GDS ratio must be under 39% to qualify for an insured mortgage. Okay. And the total debt service ratio compares all of the borrower's debt obligations, not just the housing debt, to their gross income. A TDS ratio of 44% or lower will qualify for an insured mortgage. Okay, so let's look at an example. It's kind of an in-depth example that will go through how these are calculated and whether or not an individual will qualify for a mortgage based on these two ratios. Okay. So here we go. So example, Draco made an offer on a home for $670,000. He has $134,000 for a down payment. So I kind of wrote this down. These two should be switched, so I'll just read this first. He will require $536,000 for a mortgage, and how you calculate that amount is the $670,000 that the home is minus the $134,000 down payment that he has. So his loan to value ratio is 80% because it's 536,000. That's the total amount that he will need to borrow divided by the house purchase price, which is 670,000 equals times 100. So it's 80%. The LTV ratio is 80%, which means that Draco does in fact qualify for a conventional mortgage. Okay. So Draco's lender offers him a 25-year amortization rate at an equivalent annual interest rate of 6.7% after adjusting for semi-annual compounding and a monthly payment frequency. So we don't have to adjust this interest rate. It's already been adjusted. Okay. So to calculate Draco's mortgage payment, we will input the following information. So the present value is $536,000, right? That's how much he needs to borrow. So we're going to first do second function alpha 0 to clear the memory. So $536,000 is the present value. The interest rate is 6.7 divided by 12 because we don't have to do any adjusting for the interest rate, and divided by 12 because it's going to be monthly payments. 6.7 divided by 12 interest. And for the next 25 years, and he's going to be paying monthly, so 25 times 12. And the future value will be 0 because you'll have it paid off in 25 years. So how much are his mortgage payments going to be? Compute PMT. So Draco's mortgage payments will be $3,686 per month for the next 25 years. Okay, so that's how much his monthly payment will be. So we'll keep this value in mind for when we're calculating the GDS and TDS ratios. So in addition to his mortgage payment, he has to pay $3,500 in property taxes and $2,600 in heating costs. His total housing cost per year is $50,332. Okay. So Draco's gross annual income is $120,000, which is a mix of salary and commission income and can vary year to year. He has a fair credit score. So let's calculate his GDS ratio. So GDS is total housing costs, which is $50,332 divided by his gross income, which is $120,000, and then times 100 for the percentage. So $50,332 divided by 120,000 equals times 100. So 42%. So his GDS ratio is 42%. Okay, so now let's calculate his TDS ratio. This is his total debt. So Draco's other debt obligations are an unsecured line of credit with a balance of $18,000. He has 2 credit cards with balances of $1,800 and $2,300. And he has a student loan with a balance of $27,000. So his TDS ratio is calculated by the total housing cost and plus other debt divided by his gross income. So let's calculate all of his other debt obligations first, because we know his total housing costs is $50,332, but let's calculate his yearly debt obligations. So what the like financial institutions, big banks usually do is they take 3% of all of the debts you owed, like your revolving lines of credit and credit cards. It's a 3% per month rule. So we add up all of his debt here, like the line of credit and his credit cards and his student loan, and times 3%. And that's his monthly, that will represent his monthly debt obligations. And so it's 18,000 plus 1,800 plus 2,300 plus 27,000, should be another zero there, equals times 3%. Which is $1,473, and we want to times this by 12 because these are monthly payments and we want to see how much they're going to be each year. So times 12 equals $17,676. So his total debt obligations for the year is $17,676. So that value is there. So the TDS ratio is total housing costs, which is $50,332 plus other debt, which we just figured out was 17,676. 17,000. Oops, gotta put a post in there. 50,332 plus 17,676 equals, divided by his gross income, which is 120,000, equals times 100. So it's 57%. So his TDS ratio is 57%. Okay, so we've calculated his GDS ratio and TDS ratio to see if he qualifies for a mortgage. So here's the result. Draco's GDS ratio is 42% and his TDS ratio is 57%, which are both above the threshold of 39% for GDS and 44% for the TDS. Even though he has a 20% down payment and LTV ratio is within acceptable limits, he does not qualify for a mortgage based on his GDS and TDS ratios. The stability of his income, if you remember, it's commission-based and sometimes bonus-based, so it's not steady. And his current credit score, which was fair. So given all these factors, he does not qualify for a mortgage despite having the 20% down payment required.